Good afternoon. My name is Robert McGroarty. I'm the Director of Subscriber Development here at Hedgeye, and I welcome you to our first show. Name's a little TBD, so bear with me here, but tentatively we're going to go with Analyst Alley. We're in this kind of first next couple weeks, because as we enter into 2023, I'm going to sit down with each of our sector heads and really dive into a little bit of their backstory as to like how they end up here at Hedgeye, and then also obviously getting more in depth into their research, their coverage list, their process, and how just some kind of highlights or topical kind of either themes that they're looking for in 2023, and or kind of some top companies that they're wanting us all to kind of be paying a bit more attention to. So today I have the pleasure of our healthcare sector head, Tom Tobin. So thank you, Tom, for being my quasi guinea pig here, and excited to kind of learn a bit more about the healthcare sector, your background, and again, was going out to all of our paying subscribers here at Hedgeye, and I think it's going to be a really fun session. So thanks again.
Yeah, no worries, and thanks for setting this up. I mean, I think it's a great. There's a lot of there's a lot that can't come through when people try to write something or make a chart or have a call. Like there's a lot of secondary and knock-on effects in terms of who you're listening to and what their experiences is, or how to read what they're saying. Like
exactly
in terms of how an idea comes across. And I would just say, like you were asking me a little bit earlier, like just to touch on the background, but I would say like what I've been up to, I guess over the last 15 years at Hedgeye is really I'm kind of there in terms of what I was shooting for when I showed up. And Keith and I had worked at a long short fund together for a bunch of years, basically showed up within a couple months of each other, helped grow a place from like, us against them, us against the world, into, a pretty big place. And, I always did healthcare. It was always long, short. I always made my money for the year off a handful of ideas. I tried to minimize mistakes. And it's basically been that sort of mantra ever since. Except when I was on the buy side and waking up at 4 o'clock in the morning because I was stressed about an earnings release and just I might as well just go into work kind of stuff. The thing that I was mostly worried about was never really the fundamental side. It was always about something else, like macro related, some other 2x4 that was coming up very quickly into the back of my head that I just didn't have any awareness for. And I as I was sort of pivoting and thinking about, okay, well, what do I want to do? So I started this journey for me as a PhD dropout in biochemistry. Like, well, what am I like? What am I capable of doing? What I want to do? I've always wanted to do this job, but what I want to do, and as what I love about this job is sort of that intellectual challenge and trying to figure it out. I love talking to people about what they do. I love sorting through the data, and the last piece, again, like where I think I am today after 15 years of picking at this, is really having a very good macro awareness, because as Hedgeye has gotten much better at the quads, I've also gotten much better at integrating into that quad framework and figuring out, okay, well, of the 300 and some odd stocks that I could be looking at today, where I have a narrative, something like I love this because I've got some story, or I feel like I recognize some value that nobody else does, just may or may not be true. But the real issue is that the factors in the quads are going to carry most of the water in that scenario. So in terms of what I've been doing is just trying to quantify and integrate and lather, rinse, repeat. So my list where I'm hunting for longs and shorts is really short. And that my job is really to get those up and out as quickly as possible. And that's the part which I've been working on more often lately, now that this kind of quad factor score system is in hand.
Yeah, and just to elaborate, when Tom says short, he really means concise/condensed, and not just only shorts. I know it's quad 4, but he's got longs and shorts, right? But yeah, so it's awesome. Yeah, and as somebody who's been, again, I'm relatively new to the Hedgeye process, finding it in March 2020, but I have had the privilege of being able to see various coverage lists across the analyst teams of the sector heads, and yours certainly has changed, right? I mean, it used to, again, I'm going to ballpark it here, but say, probably a year ago it had 20-ish names on it, and now we're down to, maybe 25, and now it's, as you said, a much more condensed list. And so maybe maybe we,
I had to shrink it, right? Like, so
yeah,
a lot of what I was doing before was trying to uncover, the story, right? Like, what's the narrative? And I think a lot of time price action is defined very quickly or attached to some story. And you come up with a reason, right? Oh, it's down a lot because the analyst is missing something. That's typically how that goes. But Keith's been really good about saying this lately. It's like it's just down because it's went up, right? And then there's an element to what, like, again, what I've found is that the factors will carry most of your water, and the question is do you have the confidence to stick with something? Again, from that fundamental view, and maybe when I started this job back in the 90s, the late 90s, really early, like 2000 was my first year when I was working with Keith. It was you could do more meetings and make more money. You could have a better narrative engine and do better. Now that's way less true, and because that's really become the commodity. And I think really figuring out, like, I'm not going to be a quant fund, right? I'm not high frequency trading,
right.
But how do I get to that idea faster, better, cheaper? With all the options out there, and I think that's really the key. So my list is shrunk because I'm like, you know what, this is a bad quad factor score or setup.
Right.
Some things that I should have gotten rid of, even though I liked them.
Yeah.
Right. Like once the quads start hitting, it's just like, forget about it. You got to go. And that's really sort of that attachment to your intellectual framework is you got to get looser with that.
Well, yeah, and Keith talks about it all the time, just in terms of inventory, right? And there's no real reason why an analyst like yourself can't use a portion of that, right? You can't be quite as churning, but if it's higher quality, it's a higher quality list, and that's what I've been obviously privy enough or lucky enough to be much more intimate with obviously the research across the board, but for the last 2 months since being here, and it's much it's just, again, we don't have to get in anyway. So maybe would you rather start with going to the position monitor, or go a bit more about like your process and how we got to the position monitor?
Well, I stuck that link in for the slide deck that we update every day. That's in our morning note, because from my perspective, I think there's a lot of stuff that crosses my desk that I'm looking at that I'm not necessarily communicating, but it tends to sort of frame out. When I notice something, I'll notice something. So if you look, I don't know if people have access to that slide, but there's a quad factor backtest slide with sort of AMN called out in terms of where it's sitting. I think it's slide 4 in that deck, Eric, if you've got that, if you can pull that up. But essentially what I've done is we've tested, so there's a fundamental factor that we call the slope, essentially the estimate momentum, which is the slope of the NTM estimate line. We measure that on a daily, it's measured weekly, but it's calculated on a daily basis. And if the slope is up and to the right, and it's comparing, that's actually not the slide, but in the not the AMN. I'll send you the link in just a second. It's in the invite that I sent out a little bit ago. So there's an estimate function, like a fundamental function, which is the slope of the estimate line. So if a name is sort of reaching the top, it tends to be slope that's beginning to turn negative. The acceleration is negative, but you need to pair that in quad 4, which healthcare, quad 4 really likes healthcare. If you want to be long something, it's got to be large cap, high margin, which we know, but pairing that with something that's accelerating on the estimate trend, is sort of a winning higher probability positioning. And what we've calculated for all of the, we've got 4 different factors that we combined and recombined. What we figured out, okay, well, what's the batting average? That's the one. So what's the batting average if we have these 4 in a row? What's the batting average for this? What's the average return? And then where does every stock that we have on our list fit on this grid? And we want to be short the stuff at the bottom and long the stuff on the top. And if the stuff on the bottom is, has a great story, work on that one first. So there's plenty of stuff on our long short list. And if you look at the performance, I guess there's like 3 slides up on slide 7. This thing seems to work really well. And it's kind of been irritating that, like, okay, so the names, I've done a lot of work already on Ensign. Ensign is a nursing home company that's repopulating because nobody went to nursing homes during COVID. Aggregate hours are starting to pick back up. That's a slide later in this deck. Shockwave has got a big TAM, a big growth story. It's been coming in lately. So I'm scheduling some calls with some docs. So I'm doing work on that one. Amgen has an obesity drug that looks interesting, and I was talking to one of our service providers who told me they actually have script data for the first time, so I might actually be able to pick up a juicy biotech. Option care, cancer diagnoses have been.
That'd be cool.
Yeah, well, Option Care is another side of that because Option Care does infusion centers mainly and primarily around cancer.
Yeah.
So cancer's been underdiagnosed during COVID. If there's a rebound in diagnoses, there'll be a rebound in infusions. Option Cares would be a winner in that situation. And then on the short side, Fulgent is a COVID play that's probably going to roll over. Butterfly is probably going to get caught up in a negative CapEx environment. Again, it's like I'd rather make up the stories about these tickers on this list than just picking them at random, because I know I have a higher probability of being right. Kids, which is an orthopedic, juvenile orthopedic manufacturer of devices, implantables, they've been hit by RSV, so their estimate trend is lower, although RSV rolling over and finally abating probably is a tailwind for them. So I'm not going to, and then, Inhabit or some of the home care names probably have a much worse time with wage inflation than anything else. Anyway, but that's where my head's at. So I've been, again, on the long side.
On an anecdotal basis, having to short kids the ticker, that might be a little.
Yeah, I'm going to short kids. That's not an invite I want to write.
That might be a little tricky, right? Yeah.
I'm short kids.
Short kids.
That's right.
But I mean, this is so. Yeah, so let's. This is one of the, again, we're going to do this across the board, across sector heads, but you in particular have quasi pivoted to really harnessing in on this quad factor score and this quad model. So if you don't mind, I know you kind of briefly touched base on how you got to these, or the names that are popping off the page and perhaps why, but do you mind providing just maybe, and again, I know it's a pretty detailed process to how you got there, but sort of just some of the highlights as this maybe some of the again, we don't have to give the nuts and bolts, but sort of some of the data that might flow in, or kind of some of the pieces that really impact, and like how do you get to this page, right? Like how do you get to that quad factor performance page?
So each week there's a process that the data team run, and we're ingesting, and then we're improving this thing over time. But we're ingesting a bunch of data from FactSet into our own proprietary databases. It's the same underlying data that drives Josh Steiner's AI product. So, some of the work that he's done to figure out what are the best longs and shorts in financials. And then, I've been working on this slope of the estimate line thing for some time, but it really kind of it didn't fall apart, but it really lost a lot of its ability or capacity during sort of the first stages of COVID. And I didn't really, been retrofitting and figuring out why did that happen? I think there's a tendency when I've done the data science stuff, and ostensibly I'm involved in a lot of that here at the firm. The more complicated it becomes, the more factors you bring in, the less you can explain it. And frankly, my bias is that the more likely it's not going to hold up. And the simpleton stuff, what's the most common factor? So what I did is I went one by one, and I said, okay, does this factor matter? And we ran through sort of a layer cake of, we know the quads matter.
Yeah.
Okay, because we knew performance segregated, or there was a reduction in standard deviation if you separated by quad. If you layered in another level of microquad, or this estimate momentum factor, you got even more standard deviation reduction. So you're ending up in a tighter band or tighter pool of sort of probability of an outcome. And we went through this process. It's essentially a learning tree, but learning trees in data science, they'll go through millions and millions of layers, and it'll become so complicated at the end, like your tiny little bin. It's like, well, why is it like that? I don't know, right? Like, it can't be explained. In this case, we really restricted ourselves to stuff we could explain on the front end, and we restricted it to stuff that essentially worked. So I did a lot of this, essentially the stats by hand. And if something didn't work, we kicked it out. So short interest actually is really helpful in quad 1 and 2. You never want to be long anything that has short interest above 4 or 5 days to cover. That just, you really want to stay short that. But you might, you want to look for the short interest as a factor in quad 1 and 2 because it's more informative. In quad 4, it's less helpful, so it's not included here. But we have this table on that slide 4 with AMN called out across all 4 quads. Mm-hmm. So in each case, we just went through by sequence. It took a couple of months to really finish this thing out. And I'm sure I'll be iterating.
Tom, for people at home, that's ranked like worst or
batting average. It's ranked on batting average.
By batting average. Okay, sorry.
Yeah, weekly batting average.
Okay, great. So that's best performing to worst.
Right. Okay. And I don't care as much about, and also the decision we made to choose batting average over average performance, because I want winners. If we're looking on a weekly basis, I'm essentially eliminating a lot of the beta components, and it allows me, I think, more accurately to look at the smaller caps. So you'll see in quad 4, like all the bottom categories are EV minus. That just means we decided on a break point of what's like large cap and what's small cap. We've decided on a break point of what is positive estimate momentum and negative estimate momentum, and so on and so forth. And you can see, everything in the upper bins is large cap, everything in the lower bins is small cap. That's the primary one, but the others are very helpful and informative as well.
Awesome. Yeah, that's amazing. And again, we could talk about just the back test and the factor and the factors that go into it for probably hours on end. So the other one that I really wanted to bring up for those at home is the estimate monitor ETF. So Eric, I think that is 1 or 2 slides below that. That last
10.
One. That'd be slide 10. I think that one was really interesting, just where a lot of folks, within Hedgeye Nation, they trade, primarily ETFs. Yeah. So would love just to get you to run through, that slide for everybody, and then, we'll.
Yeah. So if you roll up the quad factor scoring for the underlying constituents of these ETFs, obviously XLV is the top, right? It should be, big, liquid, high margin. The fast growing part is more or less important, but the proof is in the pudding. So when does the sell side start to take numbers up? And I'm, from a macro top-down perspective, I'm pretty bullish on healthcare consumption because I think there's a lot of pent-up demand. I think the comps are easy, and the data tells me so. Mm. And what I'm waiting for, and to pounce on some of this stuff, is if you look in the top right-hand side, what you're seeing is that I built a little index, so I can monitor improvements in the underlying estimates. And what we're seeing so far for 2023. Right now, Pink and ARCG are starting to pick their head up a little bit. That's a first time in a while. Mm. ARCG is terrible. It's the lowest ranked factor exposure. XBI isn't that bad on the factor exposure because it has a lot of these big cap, profitable biotechs like Amgen. But ARCG has a bunch of stuff that just, it's already been hated in quad 4, but it's going to continue to be hated in successive quad 4s. So Pink actually shows up like, oh, I should personally, and then I took these, I've lather rinse. I'm going to put these all back on my position monitor this coming Monday.
Okay.
Sorting them out and because I want to trade them on my PA and I want to communicate that to people. So I want to buy some Pink and to buy some calls on Pink because if the estimate trend is picking up, the quad factor score is correct. That should be, continue to be a winner here into, JP Morgan, Easy Comps, and 2023 numbers that are starting to pick up.
Yeah, wonderful. No, it's super helpful. So that actually kind of dovetails well into going into the position monitor. And, again, we don't need to touch base on each one of them, Tom, but perhaps we could, certain companies that you really think are worth putting on the radar going into 2023. You just mentioned the JP Morgan Healthcare Conference that's coming up. That's been kind of a quote catalyst that you've talked about on the call and stuff like that the last few weeks. So maybe, again, you don't have to use that specifically, but we'd just love to get sort of some, again, I know you added AMN today. You did that black book. So for any institutional accounts, that went out to all of them this afternoon. And with that, I'll pass it over to you.
Yeah, I mean, I think, so behavioral has gotten my attention. So ACHC is the psych hospital system. There's a lot of capacity, I think, that's been, as others sort of ration or streamline their service offering, a lot of the acute care hospitals, that there's going to be a net share gain for places like ACHC and UHS, which is in the long bias list, which I'm working on pretty a lot lately in the last couple of days. And then the macro data, aggregate hours for psych and substance abuse hospitals had been negative for like 2.5 years and only recently went positive. So during COVID, getting patients in a psych hospital to wear a mask, just the level of stress that was there, the staffing issues, it became very hard to keep and maintain capacity. So there was a and the same is true with nursing homes, and which is where Ensign comes from. So I'm pretty bullish on consumption and the return of growth in the behavioral health segment, and at the same time, average hourly earnings. Again, wage inflation has been the big bugaboo for healthcare and for everybody else, frankly, but for healthcare in particular, wages are actually in decline for the last couple months. So they're first amongst many, but healthcare wages, one of the points I made in the AMN presentation earlier was that wages are, inflation is slowing. For ACHC, it's actually coming down. At least their industry is reducing or falling on a sequential basis. So I like that twin. What does that mean? That means margin expansion. They also have a pretty sweet, not sweet, but they have a very good business in these community treatment centers. They've been opening them. They're very easy to staff, relatively speaking. There's a lot of demand. I think it's very recession resistant. So they have sort of a lot of leverage to growth. And when they did their analyst meeting, they sort of laid out yet again a sort of a delay in their capacity expansion. I think, again, if wages are coming down, they're going to be able to speed up their expansion. We have a couple of slides. I don't know where that is. But
I was just going to say, Eric, do you mind pulling up the position monitor quad factor score just while he's talking? That way, folks can take a look across the board, sort of what the factor score looks like.
So
Perfect.
So and ACHC actually has a pretty high batting average. It's not in one of the categories we're calling long just yet, although I think I'm going to change that because there's a lot of nice names in that bin.
Yep.
But yeah, I mean, it's got a really nice. What I'm doing is I'm assigning based on historicals. What is based on not ACHCs specifically? I want to know how its factors, including the fundamental factor of estimate momentum, like what is the batting average and average return? And 57% on a weekly basis is pretty good. The historical database has about a 5.7% frequency, so that occurrence actually is pretty high across all prior quad fours. So that's pretty good momentum. So I feel like that's a very good bet, and it's held up. Like really, it's been a great stock. Again, not so much that. Like they actually had a pretty disappointing update at their analyst meeting, I would say. But I think what's caught it and what's really buoyed the name has been more along the lines of, well, it's quad 4, 23 is going to be good, and the quad factor score actually supports it. Like either the robots or other people have recognized this, and that's what I'm drifting off of.
Yeah, it's awesome. For those at home, I mean, what you'll notice here is there's a ton of numbers. There's a ton of numbers that drive these decision makings, and Tom's got these quad factor scores that he's come up with and back tested, but it's always numbers first, right? So you'll notice that across for the next 2 months while I sit down with all these sector heads, you're going to notice a key theme here, and it's the decisions are rooted and based in the data and the numbers, and then they get to the positioning in terms of where they are on their on their position monitors. So I think I just wanted to reiterate that, Tom, because I don't think you've highlighted some of the kind of the theme as to how it would influence it, but you're obviously starting with the numbers first.
Well, I'm starting with a filtering process and a way to score my own narrative. Right? Like, so if I'm falling in love with something, it's best to move on, right? Like it's best not to. Be wed too much to some great idea. And if you can't get it done fast enough, you can't get it done fast enough. That's just like he says, just move on. Again, like I think something like a 10x genomics on the short side, quad factor score is definitely at 52% is pretty low, relatively speaking. We have some that sort of, are below 50%. So you got pretty good odds you're going to be right. In this case, pretty good odds you're not going to be wrong on the short side, I guess I'd phrase that. And then the fundamental data has been so terrible that
Yeah.
I don't have to worry about it too much. Like I understand the underlying grant trend that supports their revenue. We update it every so often and just check in. And then my job is really just to not change unless I really see something, moving the wrong way.
Amazing. No, very good insight. And Generon, do you think we could sort of finish off with the position monitor performance slide? I believe it's the next one down. And yeah, perfect. And that way, Tom, if you don't mind just kind of running through, how you, I guess, created this slide, or sort of like what the, was it when they got turned on or put onto
Yeah,
your
no, I
monitor?
mean, we don't, Parcio has a lot. I mean, we can't really create a portfolio necessarily.
Yeah,
I am just putting it on the 1 day, 1 week, 30 day, and 90 year to date kind of thing.
Yep.
It shows that, the shorts are better than, the longs are better than the shorts, generally speaking. I think batting averages are really good. I've been anchoring more and more on that because the relative change,
Yeah.
You can always make money if your batting average is up. So
Absolutely.
I pay attention a lot more than what the volatility within the different name is. But yeah,
And you mentioned that, sorry, Tom, just to expand on that, you mentioned, I believe at the beginning of this, to again bring it full circle in terms of being a portfolio manager, right, and healthcare focused. Was that a key in having a few kind of core winners really make your year? Has that always been a focus of yours in terms of looking at batting average
yeah.
and sort of trying to?
Well, listen, there's one person only has a certain amount of hours in the day, right? I only
100%.
have so much capacity. Part of the trick of Hedgeye has been, when we started, we had nothing, right? Like I used to fly first class. I used to stay in hotels. I used to have an assistant. I used to have a budget for research. And then I drop, on the moon, and I've got, here's a roll of duct tape. It's a bubble gum. Go. And that's really what this has been about. To make do with what you have, and that's kind of the genius of what Keith has set up here, because we're each hustling it as like, where's my return on the marginal effort, and again, like how do you shorten that cycle, both from just providing good research, with an institutional audience, with a mass audience, with an RIA audience, like the whole. Ultimately, I just simplify my life to, I just really want stocks to, I want to be right mostly, and I want them to go up a lot, and I want to go down a lot when I'm short. And so for me, like historically speaking, like, yeah, I would look back almost every year, and I would probably have any given time 12 to 20 names on. A lot of small starter stuff, positions. I can't really do that here. Maybe the bench is kind of like that. And then, I would really, like on the morning call, we would have to go around the horn, and I would talk about something that I really love, because I knew if I got my PMs to buy, a 4 or 5% position, I was going to make a lot of money that year, and that the firm was going to do well. I was going to do well. And it was, and I remember my first big short was like, I was on the call every day for weeks and months, saying you should short this stock at any price. And one of my bosses were sending me all cap AOL IMs, like, this stock goes up every day. And I was like, short more, like, and that's really like that. So I feel like, you gotta take a shot faster. And that's something I got to get better at. But again, like figuring out how to do this with, in the fastest, most reliable way possible is really what we're doing here. We've got a bunch of sectors who have been incredibly creative, and we're all sort of learning from each other as we, again, nothing stays the same. You got to keep moving and shucking and jiving and make it happen.
I couldn't ask for a better first session here with yourself. It's been, it's been awesome. So again, I get the pleasure of speaking to you often offline via Slack, talking about IMs, et cetera, and I think today we gave the Hedgeye Nation a glimpse into obviously your healthcare practice and also a glimpse into the brain of Tom Tobin, which probably is a little scary. No,
Well,
but
yeah,
it's a brilliant thing, and so no, I really appreciate your time.
sure. Thanks, Robert, and thanks for everybody for tuning in. I mean, I think we got a lot of cool stuff going, and it's getting better. So
we do. I completely agree. And if you check your inboxes, we just sent around a holiday kind of special, right? You can give the gift of Hedgeye to loved ones, right? So rather than buying, that toque, as we Canadians would say, otherwise known as a winter hat, you can give the gift of the macro show, et cetera, et cetera. But if you're interested in learning more about about Tom's Healthcare Sector Pro product, please visit either our product page or email support@hedgeye.com. We'd only scratch the surface of what he's doing on a daily basis. So again, I just want to thank Tom Tobin, and want to thank you, Hedgeye Nation. So again, this is a special time of the year for all of us here, and we're very grateful for you for you and your commitment and your ongoing support. With that, I will bid you adieu, and hope you have a wonderful rest of your Tuesday.